Most people believe wealth is reserved for those born into privilege or blessed with extraordinary luck. They spend decades working hard, earning decent salaries, yet somehow never break free from the paycheck to paycheck cycle. The truth is far more empowering. Ordinary people become wealthy not by earning massive salaries, but by acquiring assets that generate income while they sleep. These are the tools the wealthy use to multiply their money, and they are accessible to anyone willing to understand how they work. The fundamental difference between those who build wealth and those who struggle financially comes down to one simple principle. Rich people own assets. Everyone else trades time for money. An asset puts money into someone's pocket month after month, year after year, without requiring constant effort. A salary disappears the moment someone stops working. This distinction separates financial freedom from financial dependence. Asset 1. Dividend. Paying stocks. The first wealth-building asset transforms companies into personal income generators. When someone purchases dividend-paying stocks, they become a partial owner of established corporations that regularly share profits with shareholders. These payments arrive like clockwork, typically every 3 months, providing a steady stream of passive income. Companies that pay dividends tend to be mature, financially stable businesses with proven track records. They include household names in sectors like consumer goods, utilities, and healthcare. These businesses generate consistent profits and reward their shareholders by distributing a portion of those earnings as dividends. The real magic happens through reinvestment. When dividends are automatically used to purchase more shares, the investment grows exponentially over time. A person who invests $10,000 in quality dividend stocks might receive $400 annually in the beginning. After 20 years of reinvestment, that same position could generate thousands in annual income. Some companies have increased their dividend payments for 50 consecutive years or more, creating a rising income stream that outpaces inflation. Asset 2. Index funds. The second asset democratizes wealth building by making professional-grade diversification accessible to everyone. Index funds allow ordinary investors to own tiny pieces of hundreds or thousands of companies through a single purchase. Instead of gambling on individual stocks, investors capture the overall growth of entire markets. The beauty of index funds lies in their simplicity and low cost. A single fund tracking the 500 largest American companies provides instant exposure to technology giants, healthcare innovators, financial institutions, and consumer brands. The fees are minimal, often less than 0.1% annually, meaning more money stays invested and compounds over time. History shows that markets trend upward despite short-term volatility. Someone who invests $50 monthly in a broad index fund for 40 years could accumulate over $500,000, assuming historical market returns. The strategy requires no special knowledge, no stock-picking expertise, and no constant monitoring. It rewards patience and consistency above all else. Asset 3. Rental real estate. The third asset builds wealth through the power of leverage and appreciation. Rental properties generate monthly income from tenants while simultaneously increasing in value over time. This dual benefit makes real estate one of the most powerful wealth-building tools available. Consider how rental properties multiply returns. Someone purchases a property for $300,000 with a $60,000 down payment. Tenants pay rent that covers the mortgage, property taxes, insurance, and maintenance, while also providing positive cash flow. As the property appreciates at 5% annually, the entire property value grows, not just the down payment. This creates substantial returns on the initial investment. The tax advantages add another layer of benefit. Property owners can deduct mortgage interest, property taxes, repairs, and depreciation, significantly reducing taxable income. Many investors build portfolios of multiple properties, creating substantial monthly cash flow that eventually replaces employment income entirely. Location matters tremendously in real estate investing. Properties in areas with strong job growth, good schools, and increasing populations tend to appreciate faster and maintain higher occupancy rates. Professional property management can handle tenant relations and maintenance, making rental income truly passive for investors willing to pay for the service. Asset 4. Business equity. The fourth asset represents the most direct path to significant wealth. Owning equity in a business, whether self-started or purchased, creates income that continues flowing regardless of how much time the owner dedicates to daily operations. Business ownership separates the ultra-wealthy from the merely comfortable. Statistics reveal that most millionaires and virtually all billionaires own businesses or significant equity stakes in companies. Building business equity provides something employment never can: unlimited upside potential and the ability to sell for multiples of annual revenue or profit. The path to business ownership takes many forms. Some people start companies from scratch, building them slowly over years. Others purchase existing small businesses like laundromats, car washes, or service companies that already generate steady cash flow. These established businesses often sell for reasonable prices relative to their earning potential, especially when current owners are ready to retire. Even small equity positions in successful businesses can transform financial outcomes. An early employee who receives 2% equity in a startup that grows into a $100 million company owns a $2 million asset. Business equity compounds as the company grows, creating exponential wealth that salary increases never match. Asset 5: Real estate investment trusts. The fifth asset brings real estate investing within reach of those who lack capital for full property purchases. Real estate investment trusts, known as REITs, own and operate income generating properties like apartment buildings, shopping centers, office towers, and industrial warehouses. Investors can purchase shares just like stocks, gaining exposure to professional real estate management without property ownership responsibilities. REITs must distribute 90% of their taxable income to shareholders as dividends, making them reliable income generators. Many REITs pay monthly rather than quarterly dividends, providing consistent cash flow. The diversification within a single REIT often spans hundreds of properties across multiple markets, reducing risk compared to owning a single rental property. Different REIT categories focus on specific property types. Some specialize in healthcare facilities, others in data centers, and still others in residential apartments. This specialization allows investors to target sectors they believe will perform well while maintaining broad real estate exposure across their portfolio. The liquidity of REITs offers a significant advantage. Unlike physical properties that can take months to sell, REIT shares can be traded instantly. This flexibility, combined with professional management, makes REITs an attractive option for investors seeking real estate exposure without the complexities of direct ownership. Asset 6: Bonds and fixed income. The sixth asset provides stability and predictable returns in any wealth-building strategy. Bonds represent loans to governments or corporations in exchange for regular interest payments and the return of principal at maturity. While bonds typically generate lower returns than stocks or real estate, they serve a crucial role in preserving capital and generating reliable income. Government bonds offer the highest safety, backed by the full faith of national treasuries. Corporate bonds pay higher interest rates to compensate for slightly increased risk. High-yield bonds from less creditworthy companies offer even higher returns for those willing to accept additional risk. The power of bonds lies in their predictability. An investor knows exactly how much interest they will receive and when their principal will be returned. This certainty allows for precise financial planning, especially important for retirees needing dependable income streams. Strategic bond allocation reduces overall portfolio volatility. When stock markets decline, bonds often maintain or increase in value, providing a cushion against losses. This stability allows investors to stay the course during market downturns rather than panic selling at the worst possible moment. These six assets form the foundation of wealth creation for ordinary people willing to prioritize ownership over consumption. The journey from financial dependence to financial freedom requires patience, discipline, and consistent action. Small investments made regularly over decades compound into life-changing sums. The wealthy understand a fundamental truth that escapes most people. Money makes more money far more efficiently than labor makes money. Every dollar invested in quality assets works continuously, generating returns 24 hours a day, 7 days a week. The earlier someone begins acquiring these assets, the more time compound growth has to work its magic. Financial freedom is not about becoming rich overnight or discovering some secret strategy. It is about systematically building a portfolio of income, generating assets that eventually produce enough cash flow to cover living expenses. When that moment arrives, work becomes optional. Time becomes truly your own. That is the promise these 6 assets hold for anyone willing to pursue them with consistency and patience.